When you are out there researching ways within which to get into buying commercial real estate, financing is an incredibly important part of the equation in putting your capital stack together. And when you're out there educating yourself on different lending options, you're going to come across a term called non-recourse financing quite often. And in this video, I'm going to cover as to why non-recourse is the juice is just not worth the squeeze. I'd been a real estate investor for 18 years. And when I was researching non-recourse financing versus recourse financing, while I was buying bigger and bigger deals, I found that it just really wasn't worth it. I'm going to cover the 5 big reasons as to why it is really just for the birds. Some background here is I was able to actually experience this secondhand by being a director of operations for a national real estate development company. And so there were deals that were in my management portfolio for properties across the nation, across various different commercial asset classes that were put on with recourse and also non-recourse financing. So that's actually where I got my start to understanding this whole concept here on different financing vehicles. But before I get into that, and the 5 reasons why, what is non-recourse financing? Okay. So recourse financing typically is that when you take out a loan to buy a commercial income property, if you default in that loan for any reason whatsoever, and the bank forecloses on the property and they sell the property at a foreclosure auction and don't have enough proceeds from that foreclosure sale within which to pay the entire debt amount on there, then the bank can actually go after you or any personal guarantors personally to reclaim that. Okay. So this is the reason why non-recourse financing has become kind of popular, especially in the multifamily syndication space, is that if the deal goes sideways and all the investor equity is wiped out and there's still money that's left owing over, then nobody's personally liable. Okay. One, with non-recourse financing, there still is a provisions for that, and they're called bad boy carve-outs and usually associated with gross negligence or fraud on a property. So those are the only 2 carve-outs as it stands, right? So if you're buying a higher risk property, then you could be protected in the event of a total, nuclear event happening to your deal. Okay. So I'm going to go into great detail into why non-recourse financing is not all it's cracked up to be. Okay, so number 1, all right, let's address the interest rate issue. Generally speaking, non-recourse loans come with higher interest rates, which translate into a higher annual debt service for those deals you do, which influences profitability on the deal. It's a higher risk deal for a lender to do non-recourse. So therefore, there's going to be a risk premium that's going to be built into non-recourse products, typically speaking. All right. Secondly, the loan to value ratio is usually lower with non-recourse financing. This means you have to put up substantially more capital, risk capital as a down payment, increasing your initial out-of-pocket expenses, and also increasing the size of your capital raises when you're raising OPM for these deals as well. So you may be used to getting 70 to 80% LTV on a particular investment property deal. On a non-recourse, a lot of times I've seen term sheets at anywhere between 50 and 60% LTV on those deals, right? So you have to put in, you can't utilize leverage as effectively when you are buying properties that with the objective of rapidly increasing their value within which to go and refinance the properties and get all of your investors paid back their investment capital or a substantial amount of their investment capital back, or even your own if you're just using 100% of your own money. The third point is compliance. All right. So a funny story is that in this development company I used to work for, there was this ongoing joke that when we closed on a non-recourse finance deal, that the closing attorney should give the business card to us of a special servicer. All right. And a non-recourse, because there's a lot more risk associated with the actual lender itself, they're going to actually require an ongoing compliance process so they can monitor this property over time so that they can anticipate whether it's going to get into trouble before it actually gets into trouble. All right. A quick story so this oftentimes requires quarterly submission of financials. Okay. This is like income statement, rent roll, all that sort of thing. Sometimes I've actually had deals where they were required monthly to the lenders. Okay. So think about how big of a pain that can be. And then also there is typically an annual inspection that's almost like an insurance inspection where the loan servicer will send somebody to your property, usually somebody from out of town that will walk the property and note any concerns associated with that. And I have a quick story. I started in this position and I was responsible for conducting these inspections and meeting with the representative from the loan servicing company. And what happened was could have been a absolute meltdown for our company. There was a distressed apartment deal that I was charged or hired to reposition that property and get it to making cash flow again, right? And so we had this, inspection that was 10 o'clock on a Wednesday, flew into South Carolina the night before then. And I got to there about a half an hour early to meet with the property manager, let them know, hey, just stay out of our way and that sort of thing. And, don't answer any questions, that sort of thing. Well, this loan servicer rep came to the property like an hour and a half before our appointment, right when the offices opened, met with the property manager and started asking them all these types of questions, right? And one of the questions that this loan servicer asked was, are there any down units? Okay. A property manager typically does not know what a down unit is. And so he said he thought of the vacant units, right? It's like, oh yeah, we actually have 10 vacant units. This is a 160 unit property. We have 10 vacant units at this time that are currently down, right? So this inspector wanted to go and see those units, took a bunch of photographs. And before we knew it, long story long, is that we got placed into special servicing. And when you get placed into special servicing by a non-recourse lender, they are essentially in the business of putting an anal probe up your butt and really making your life a living hell as a result of that. And also, this is just something that can happen that can put you in jeopardy of losing control of the property. So if a special servicing gets bad enough, and this is like essentially where you end up getting a boss and like, okay, hey, what's our 30, 60, 90-day property improvement plan? And all this stuff. And also in the past, we've actually had a special servicer place us in what's called a lockbox, where they will take all of the revenue from the property, and then we would have to submit for reimbursement requests to actually get us out of special servicing and that sort of thing. So compliance thing is definitely not something to be understated at all, especially when you're buying a property that needs a significant amount of repositioning and value add. All right. Fourth is the inflexibility with guarantors. All right. Community and regional banks, which are recourse lenders, typically offer greater flexibility regarding your personal guarantors within an ownership group. Let's say you're buying a 50-unit property, like some of my clients just closed on a 50-unit property, that you can have collectively the net worth of the loan amount, for instance, to demonstrate your strength as an ownership group that has the net worth and liquidity in order to have the strength for this financing, okay? In contrast, non-recourse lenders are very stringent, requiring a key principal or a KP to have a substantial business balance sheet and liquidity to cover all the debts if things go south, all right? So, this ownership group that you have of, let's say, 2 to 4 individuals, they may have the net worth and the balance sheet to satisfy typically recourse financing. You would actually have to find a key principal, like a third party. You'd have to pay or give them equity, diluting other people's equities in the deal in order to come on and demonstrate their strength as a key principal in that, okay? So that's a big game changer, right? And this is definitely not flexible. Also, the actual underwriting on the guarantors is actually pretty, it's like typically when you're going through regional or community banks, when you're filling out a personal financial statement, they're actually like, taking your word for it, right? So that property that you own that's worth $200,000 and you owe $100,000 on it, is that, they're generally going to be a lot more stringent on that. Also verifying your liquidity position and also the value of your other marketable securities. So if you have, let's say, $100,000, you're saying this in the bank, they're going to want to see your actual bank statements in order to verify that, for instance, which with community banks, it's more of like a honor system, so to speak. All right. So the last, but not least, okay, the fifth reason why non-recourse may not be a great option for you and should not be considered the holy grail when it comes to financing commercial investment properties is there are simply more recourse lenders than non-recourse lenders. All right. This shrinking the pool could mean not finding a lender for your specific deal. This can lead to a scenario where an otherwise excellent deal can't be executed due to those non-recourse limitations. So sure, go out and shop term sheets for non-recourse financing, assuming that you do have the balance sheet and also key principal in place to do that, as well as more down payment money and all that sort of thing. But having your options open with also recourse lenders as well, which are generally going to be more flexible, opens up your world from a deal acquisition standpoint to not being so pigeonholed and, having to, look for deals. And also as well, the underwriting is significantly more rigorous when you're pursuing non-recourse financing. So you could have a contract that is a smoking hot deal that is 75% occupied. For instance, it's an multifamily apartment deal, and a community bank or regional bank might do that deal because you have a proven track record, you have a business plan in place. Well, typically non-recourse lender, anything below, let's say 80% or even sometimes 90%, they won't even look at it or even touch it. Okay, so you could pass on a completely great life-changing opportunity because you're inflexible as it pertains to your finance you have lined up. Okay. So in conclusion, my final talking point is if you're so worried about the deal going sideways that you rely solely on non-recourse financing to mitigate risk, you might want to consider whether the deal is worth it at all. All right. Think about this. All right. You're getting 60% LTV or even 70% LTV. All right. Every deal term sheet's going to be different, but let's say 60% LTV. You have to raise 40% of that in terms of equity. All right. For things to get bad enough to get the benefit of non-recourse finance, you'd have to have all of your partner equity wiped out. Okay. And still have money hanging over that you owe the bank. All right. How risky is this deal where that is attractive? How bad do things actually have to get? All right. So usually speaking, it's like if a deal actually has that type of scenario, even likely, okay, even possible, I won't do that deal. It's too dang risky. All right. We invest in stable markets with high barriers of entry, with stable employment bases, incomes, all of that stuff, to manage those risks so that we never, ever have to get into the scenario of wiping out 100% of the equity. All right. So when you weigh all the factors, all right, the higher interest rates, lower LTV, rigorous compliance, limited lender options, and inflexibility with guarantors, the cost benefit of non-recourse financing starts to look less appealing. All right. And sometimes the juice just isn't worth that squeeze. All right. So if you got value out of this, if you have any comments, if you think I'm full of BS on my opinion on why non-recourse financing is for the birds and is something that is definitely should not be held in the regard that it is, drop a comment down below. Also, if you have any questions on any type of commercial investment, income property, acquisitions, redevelopment, repositioning, any of that stuff, I have going on 19 years of experience as a real estate investor. Drop your question down below. I'll create another video that's just like this. And always, if you ever want to hop on a one-on-one, my job as a scale advisor is helping experienced real estate investors scale into doing larger deals without having deal flow or capital as a bottleneck to their growth and scale from there. So definitely be sure to check out the description below and book in a call. I'd be happy to see if I can actually help. All right. Take care. Peace.